All right. Welcome to part 4 and our ultimate part in the corporate distribution series. Okay, so the last part of this, we're largely going to spend talking about distributions that are not in cash, but rather in property. So obviously, a corporation does not have to distribute cash. It could do what's called an in-kind distribution, which means that it distributes something that it owns, an asset, intangible asset, something along those lines. So let's do a quick overview of what are the tax issues associated with a property distribution. One is that you will recognize gains but no loss to the extent that there is appreciation on the underlying asset, so that gain is recognized to the distributing corporation. The gain is included in the E&P, of course, but then the distribution reduces the E&P, generally by the fair market value of the in-kind distribution. The fair market value of the distribution is tested for dividend treatment. So that's the amount you determine if there's adequate E&P. If there's adequate E&P, then of course it is a dividend. And then you examine what is the tax basis to the shareholder for the property received, and it is generally fair market value. Okay, so let's start in with some examples. So Sally purchased all the stock of Small Corp 7 years ago for $8,000. At the start of the year, Small Corp has accumulated E&P of $25,000 and current E&P of $0. Small Corp then distributes its inventory to Sally. And let's say that that is $20,000 fair market value, and Small Corp has a basis in that inventory of only $11,000. Assume Small Corp has a 21% corporate tax rate, which is pretty standard fare. So what are the tax consequences to Sally and Small Corp? And what we need to do is consider, first off, is there a gain or loss to Small Corp? What's the treatment of the distribution to Sally? What's the basis of her property? And what happens to Small's E&P? Okay. So Small Corp has a recognized gain of $9,000. That is the difference between the $20,000 fair market value and the $11,000 basis. Therefore, it recognizes that gain. It has to pay 21% tax on that gain. That represents a net increase in current E&P of $7,110. The property comes out as fair market value as a dividend to Sally because, of course, there is plenty of E&P in this case to cover it all. Recall that they had some accumulated E&P at the start of the year. So there's adequate E&P to treat this as a dividend as far as Sally is concerned. The tax basis of that property is the fair market value to Sally. So think about why that makes sense, right? So there's been a gain recognized. It's coming out at market value. She recognizes the dividend at market value. So of course she deserves basis at market value. What happens to the E&P of Small Corp is we started at 25. We generated that net gain, so the after-tax gain, 7110, less the 20,000 distribution at market value leaves them with 12,110 of E&P going forward. Okay, a few more rules. If that property is lost property, as we said, that loss is not recognized. The fair market value of the property distributed is a dividend to the extent of E&P. E&P is reduced by the adjusted basis of the property, not its market value. So let's do a quick example. Corporation has E&P of $15,000, distributes property with a basis of $15,000 and a fair market value of $10,000. So this is not lost property. Lost property would be you could never find it again. This is lost property, so the dividend is $10,000. That's the fair market value. But note that E&P is reduced by the adjusted basis of the property, right? So if you think about it, that is exactly what would happen otherwise, right? So if they were to sell that property, think about what would happen. There'd be a $10,000 loss. $10,000 of money would escape, right? Through the basis, and they'd recognize the $5,000 loss, so they would end up in the same place as if they sold it. So let's say Sally purchased all the stock 7 years ago for $8,000. At the start of the year, the accumulated E&P is 25, current E&P 0. They distribute land to Sally, 20,000 fair market value, 11,000 basis, and now it's subject to a mortgage of 16,000. Again, 21% corp rate. What are the tax consequences when we think about Small's gain loss, treatment to Sally, the basis for Sally, and then what happens to Small's E&P? Okay, so basically you have distribution of property subject to a mortgage. So small corp recognizes gain, same as they would otherwise. The fair market value exceeded the basis. That's a $9,000 gain. So they have that $7,100 increase in current E&P. The fair market value of the distribution is reduced by the debt that Sally is taking on. So now that would be a $4,000 dividend to Sally, assuming there's E&P, which there is in this case. However, her tax basis is $20,000. The E&P is, we start at 25, there's the increase from the gain on the sale. The fair market value goes out as a distribution, but the relief of the liability by the third party means their E&P goes up by 16. And they end up with 28,110 in E&P. Okay. This looks familiar, or it should be starting to look familiar. So in this case, we've got accumulated E&P and current E&P of 15,000. They distribute land to Sally. Now it's depreciated. The fair market value is 20,000. Her basis is 30,000. What are the tax consequences? Okay, so here we have lost property. So Sally has a dividend of 20,000. That's the fair market value. She takes a $20,000 basis in the land. Small generates no loss, right? Because no loss is permitted for them to take. But when you calculate their E&P, they start with 25 plus the 15, and I needed to throw in the 15 because we had a giant reduction. The reduction of the E&P is associated with the basis, not the fair market value. Therefore, they end up with 10,000. Okay, so this should look super familiar to you. So it's the exact same scenario we just did. Buys it for 8,000, E&P of 25, current E&P of 15, distributes the land. But in this case, what if Small sells the land and then distributes the cash? So Small generates a $10,000 loss, right? That's the difference between the market value and the basis. E&P is decreased by the $10,000, but then you increase it by the tax savings of $2,100. So as a result, we have 25 plus 15 minus 10 plus 2,100 minus the market value of the distribution. That gets us to 12,100. E&P is then decreased by the $20,000 cash dividend, which, by the way, is not all the cash, because in theory, the tax savings generates an additional 2,100. But if all the cash were distributed, then you'd end up at the same place, $10,000. Sally ends up with an additional $2,100 more dollars if that asset is sold. Why? Because it generates a loss that generates the tax savings. So corporations should not be in the business of distributing lost property. All right. Starting to look familiar? So 8,000, start of the year, accumulated E&P of 25, current E&P of 0. And Small Corp distributes a machine to Sally that has a fair market value of 10,000 and a 0 tax basis. But recall that E&P uses a different type of depreciation. It uses the alternative system, which is slower. So what that means is the basis for E&P isn't 0 in this hypothetical example, it's 2,000. So she originally purchased the property for $14,000, assume a 0% corporate rate. And the only reason I'm making it 0, because of course that's not true, is because that way it just gets taxes out of the calculation so that we understand we're isolating this to kind of look at how this depreciation difference affects E&P. So Sally has a dividend of 10,000, takes basis of 10,000, right? Because that's the fair market value when it comes out. Small Corp recognizes a gain of 10,000 for regular tax. But remember, we would then go through and reconcile regular tax to E&P. And as a result, we would adjust E&P by the gain associated with that timing difference, or $2,000. Therefore, E&P ultimately would only increase by $8,000. E&P is, of course, reduced by the $10,000 distribution, because that's at the fair market value. And as a result, they end up with $23,000 of E&P left. So note that the accumulated E&P has only been reduced by $12,000 for depreciation, not $14,000 as we led up to this point. So there's really no big deal. I'm just pointing out that E&P can create, having a different basis for E&P can create a difference in the way you calculate the effective E&P when you sell a depreciable asset. Okay. So a quick summary. So when property is distributed to the shareholder, the dividend equals the fair market value of the property. That is, of course, reduced by any liability assumed. The shareholder's basis in that property becomes its fair market value on the date of the distribution. The corporation is treated as if it sold the property for fair market value. However, it is not allowed to recognize any losses. It is required to recognize gains. If it's subject to a liability, the fair market value can never be less than the amount of the liability. The E&P adjustment is to deduct the greater of the fair market value, or the basis less any liability. And of course, you also need to add any gain to E&P. Okay, so shifting to our next category of distributions. What if a corporation distributes its own obligations? So gain recognition is required by a corporation on the distribution of appreciated property other than an obligation of such corporation. The corporation's E&P is reduced by the principal amount of the obligation, or think of it as alternatively the issue price if that's a lesser value. The distributee, the shareholder that receives it, it's a dividend to the shareholder for the fair market value of the obligation that's received, not the face value, whatever that might be. The tax basis to the shareholder that receives the dividend is also the fair market value when received. So very similar to property treatment otherwise. X Corp has E&P at $10,000. It issues a note. The principal amount is $10,000 to its shareholder. The note matures in 3 years and has a 0% coupon. So a 0% interest rate, of course, doesn't have the same market value as its face value. The fair market value of the note is, in this case, is only $7,500. So I just chucked in that the discount rate to make it match that is about 10%. So as a result, X Corp recognizes no gain on the distribution of the note because that's what the rule says. Corporate E&P is reduced by the market value of $7,500, but of course it would never be below zero because dividends can't reduce E&P below zero. The shareholders receive a fair market value dividend of $7,500 and therefore take basis in the note of $7,500. So there are different kinds of distributions that often represent what's known as a disguised dividend, which is they're trying to find a way to have that distribution deductible when in fact it really represents just a dividend. So excessive compensation paid to shareholders or relatives of shareholders, personal expense reimbursements, excessive rent paid to owner-owned property, excessive interest on debt or interest paid on debt which really constitutes equity, bargain sales of property to shareholders or interest-free loans to shareholders. These are all ways that you're trying to get earnings out of the corporation and treat them not as a dividend. And the IRS is, of course, aware that these are popular techniques and is likely to crack down on them. So the most glaring example of this extravagance was a $2 million week-long birthday party held by a guy named, Dennis Kozlowski. He threw his wife carried a party. It became known as the Tyco Roman Orgy because this guy Kozlowski was the CEO of Tyco. Tyco footed about half the bill for the party. It was held in Sardinia, which featured ice sculptures of Michelangelo David spewing vodka from his penis. and a birthday cake in the shape of a woman's breast with sparklers mounted on top. There's a video of Kozlowski welcoming guests, toasting his wife, and dancing to a performance by singer Jimmy Buffett. So Buffett and his group were said to have been flown in just the flight at a cost of $250,000. So as it turns out, this guy was prosecuted for stealing corporate assets, not tax issues on this party. And he was also prosecuted for sales tax evasion on artwork. So what would happen is he was buying artwork and he had it shipped to New Hampshire to avoid New York sales tax because New Hampshire has no sales tax, and then did an intercompany transfer from New Hampshire down to New York. That was a dodge, and so they finally caught him on that too. Okay, so I'm not sure why we had that nice distraction, other than it's about constructive dividends. So the taxation of dividends to the shareholder are taxed at a rate of 20%. The maximum income rate is right now 37% for compensation income that might be received. So it might actually be better to have excess compensation treated as a constructive dividend rather than compensation from the shareholder's perspective. So you also need to consider Social Security tax with respect to compensation. So what you have to do is analyze this to determine, should it come out as compensation or should it come out as a dividend? So first, let's assume there's no employee tax at all, right? So if there's no employment taxes, then look at that. As it turns out, it's actually a little better to pay it out solely as compensation because you avoid the double taxation. Ooh, that's weird. Oh, because the shareholder, in this case, is being taxed at 35%. So I'm assuming at $100,000, you're only getting taxed at 35%. The dividend is therefore 15%. Okay. So in this situation, we have to add an employment tax because the reality is that does exist. So when we apply employment taxes, both at the employer side and the employee side, now you see that actually just having the money come out as a dividend makes a ton more sense. So you can see that the after-tax amount that the shareholder ends up with their pocket in at $100,000 is $67,000 if it's just paid in a dividend. So to a closely held corporation whose income is fairly small, although $100,000 that's real money, they're probably better off just paying the dividend now. And part of that is, look, the rates are down to 21% for corporate taxpayers. So let's take it up to $1 million, right? Even at $1 million, you're still better off by quite a bit, $32,000, for just paying the dividend and skipping trying to pay yourself compensation. And you don't run the risk of course, constructive dividend for overpaying that comp. Lastly, if we go big, right? So let's go where, in theory, we're reducing the value, or I should say, we're reducing the cost of those employment taxes as they apply to compensation. You're still better off with the dividend. So we're going Trump level now, $10 million. The after-tax return is still better for the corporation just to pay the dividend. All right. So as much as individuals might despise dividends because of the double taxation, although you can see now that that's not necessarily true, corporations love them because of the DRD. So if Corporation X receives a $10,000 dividend from a wholly owned sub, if Corp X has a 21% marginal tax rate, what is the tax effect? It's zero, right? Because they take 100% DRD, and so that entire dividend comes up to them with no tax. Okay, let's put that into play and say, hey, wait, I have a trading idea. I have a strategy that I think I want to implement. So this goes back a few years, but at one point Chrysler hadn't paid a cumulative preferred stock dividend for a long time. And if you think about it, what does a cumulative stock dividend mean? It means that you declare it, but you don't actually pay it. So you've got this cumulative preferred stock dividend. The stock is currently worth $36, and it's scheduled to distribute 12. So finally, Chrysler's found its way to some profitability, and everyone's banking on the fact that they're not just going to declare the preferred dividend, they're actually going to pay it this time. And it's going to be $12, which is a big percentage of the preferred stock value at this moment. So let's say there's a corporation out there, and it so happens that they've generated a giant short-term capital gain, right? Maybe they bought and sold some stock that they owned in some subsidiary or something along those nature. But they know that they're going to have to pay, well, it wouldn't be 35%, but back in that day, it would have been 35% taxes on it. So what they do is they go out and buy 80,000 shares of Chrysler Preferred for $2.88 million. And they're going to hold it for 91 days because they want to hold it long enough to make sure that they get qualified dividend treatment and they get the DRD and all these other things. So Chrysler Preferred goes ex-div, and what's going to happen, right? Well, the price is going to drop $12 to $24. And now Corporation X turns around and sells that stock. So remember, they bought it at 36, they just sold it at 34. But they're entitled to receive the $12 dividend. So they generate this $12 capital loss. However, they receive the dividend, right? So if you and I were shareholders, we get the dividend, we have to pay tax on it. It's a wash, right? I got a 15% capital loss. I take in 15% on the dividend. It's all fine. But Corporation X is a corporate shareholder. They take a DRD, again, back in the day, 70%. Now it would be 50%, not 65, right? And as a result, they reduce the taxability of that dividend down and end up creating net tax savings because they've generated a paper gain that offsets that actual short-term loss. That's called dividend stripping, and it is a no-no. Section 1059 says the treatment of extraordinary dividends under these dividend stripping rules says what has to happen is you're going to have a tax basis reduction and then gain recognition after the basis recovery. That's an extraordinary dividend that's going to occur when 10% or more of the tax basis is received in an 85-day or shorter period. So what that means is an extraordinary dividend is a pretty big dividend, right? So if we reflect back on that last example, it was $12 on a $36 stock. That's a 33% return of tax basis. So for preferred stock, that amount is reduced to 5%. If, however, you've held onto that stock for more than 2 years before the dividend announcement, then that has gone old and cold and you can actually engage in dividend stripping. But the idea is, well, look, you held the stock for 2 years. Who knows what happens to stock price over 2 years? So if we redo this example with the dividend stripping rules, what we would see is that when they receive the DRD, they pay the tax, but they also have to reduce their basis in the stock by the amount of the DRD. So what happens, therefore, is their new basis is reduced. Therefore, the loss that's generated is a net savings of 0. So that's the dividend stripping rules, right? How about debt finance stock? So debt finance stock is a similar planning strategy where you say, okay, I'm a corporation. I'm going to go out and borrow money to purchase stock, right? So I borrow money, now I invest in stock. It pays dividends, and I take a DRD on those dividends, right? So you can imagine I'm taking a current deduction for the interest I'm paying, but on the dividend I'm receiving, I can take a DRD and therefore exclude it. And so, yeah, this isn't permitted either. The proportionate disallowance can be done. So if you only used part of the debt to buy these shares, then there's a partial disallowance of the DRD. So this is a little bit like not being able to deduct interest on debt that you use to buy tax-exempt bonds, right? There's no expense deduction for debt that you incurred to buy tax-exempt interest. Okay. So now I have an investor corp that purchases 100 shares of a publicly held common stock for $15,000. On June 3rd, the ex-dividend date. We don't need to go through this entire thing. Basically, what we're saying is another rule that's out there is under 246C, you have to hold the stock for more than 45 days during the test period to receive the DRD at all, right? So this is getting around if you're playing the game, but it's not enough to represent dividend stripping. Under 246, we're at least going to make you hold it 45 days. So the test period in this case isn't 60 days. it's ex-div date minus 45 or ex-div date plus 45. If you haven't held the stock for more than 45 days in that test period, you're not even entitled to the DRD. Okay, last area is when a corporation distributes its own stock. Typically, if it's the same class of stock, then the argue would be that's a dividend made to retain the corporation's cash. If it's a different class of stock, then you're enabling some preferred ownership status for some shareholders. Or if you're issuing rights or warrants, then what you're hoping is that people that are already shareholders will contribute some additional stock to you, but because you're going to give them an advantageous price at which to do so. Okay, so Eisner and McComber, which is an old Supreme Court case, says a straight up distribution of a stock dividend is not income, right? So the idea is if I say I'm going to give a pro rata share of stock to everyone who owns a share of stock. So everyone who owns one share gets one share. All I've done is double the number of shares without really changing any ownership percentage. So as a result, everyone's the same. It's just now instead of one piece of paper representing a stock certificate, you have two. So gross income does not include any distribution of stock on stock. However, under Code Section 306, a preferred stock bailout does produce ordinary income. So what are exceptions to the McComber rule? So they are listed under 305 and one under 302. So 305B1, if the distribution is in lieu of money. So what that means is there's an election on the shareholders' part to take either cash or stock. Because that results in a change in ownership, that is actually a taxable distribution, both to the people that receive stock and the people that receive cash. To the stock, it would be the fair market value of the stock they're receiving. If there's a disproportionate distribution occurring as a result of the receipt of property by some shareholders and an increase in the proportionate share interest by others. So again, this is the same thing. It's just we're saying, look, it doesn't have to be cash. If it's a distribution of any other type of shareholder or it's disproportionate and it's changing the ownership rights, then there's something more going on than kind of this tax-free stock distribution. Under 305B3, it's if some people could get preferred and some people could get common. Again, we're changing the ownership structure. As a result, that is a taxable stock distribution. If there's a distribution on preferred stock, not of preferred stock, preferred stock doesn't enjoy the same treatment. Preferred stock dividends are taxable. And if the distribution is of convertible preferred, and we're not going to get too mixed up in convertible preferred, but the likelihood is that's going to create some form of disproportionate distribution. So unless you as the corporation can establish that it does not, under 302B5, you're going to get tagged with this being a taxable distribution. Well, your shareholders are. All right. So a non-taxable stock dividend has no effect on E&P. No gain or loss is recognized. A taxable stock dividend reduces E&P. However, no gain or loss is recognized, right? Because when a corporation issues its own stock, there's never gain or loss recognition under 1032. What is the shareholder treatment? If it's a non-taxable stock dividend, then they simply allocate their basis in proportion to the market values of whatever it is they received. They tack on the holding period because it's a non-taxable transaction. So for example, if I own one share, I get a non-taxable stock distribution. I now own two shares. They have the same holding period as that first share did. Code 307 says allocation of tax basis when rights are distributed, but not if the rights value is less than 15% of the total stock value. So if the rights aren't worth very much, you don't have to allocate basis. If they're worth more than 15%, then you do have to allocate basis. Are they taxable? Yes. The dividend for fair market value, right? Because we're dealing with a taxable dividend. It's a dividend for the fair market value, and of course that's what the shareholder takes in. The basis is the fair market value, and in this case the holding period starts right at the distribution. Okay, now let's deal with the section 306 the preferred stock bailout. So let's assume we have this corporation and it's got tons of E&P and tons of cash, right? So the owners are salivating because they want hold of that cash. And they're pretty sure that any of the corporate distributions it could make are going to have to pay a dividend. So here's the scheme that it cooks up. It says, here's what we're going to do. We're going to make a non-taxable distribution of preferred stock to our common stockholders. Recalling that can be treated as a non-taxable stock dividend. So as a result, the shareholder then says, oh, the fair market value of the preferred is X. The fair market value of the common is Y. So I get to allocate a portion of my basis to the preferred. Now what happens is these same shareholders sell the preferred to an investor. Let's call it someone who has a corporation that has a low tax rate and it reaps cash, but ownership is diluted by the preferred shares. So then what happens is the corporation then redeems those preferred shares at just a slight premium, a very small premium. So the corporation redeems the preferred shares, they disappear, so suddenly the ownership dilution is gone. But think about what just happened, right? So there is a allocation of preferred shares. The shareholders then sell them and generate cash. They take basis against that cash. So they've just taken a dividend and recovered a portion of their basis. And at the end of the day, there's actually no difference to the corporation. So this was called a preferred stock bailout. And what happens is corporations would approach a bank and they'd say, hey, bank, will you do this deal with us? And we'll make sure that, the corporation will redeem these shares from you at a slight premium to give you some worth to it. And that way we get a dividend distribution where we get to recognize a little basis against it. And as a result, lower the tax. Okay. So this means you get a distribution out of cap gains rates. This is why Section 306 exists. It says, look, to the extent you distribute something other than common on common, if there's no E&P, don't worry about it, right? Because it couldn't have been a dividend. That's not 306 stock, right? But if the receipt of the preferred stock is not a current taxable event, that stock is going to bear a taint, which triggers income recognition at some later date upon a sale or redemption of that preferred stock. So basically 306 is designed to cut out the preferred stock bailout. All right, we made it. This one was a little longer. I apologize. I'll see you guys in